Hi guys, I'm here with Joseph Hogue. He has a very large YouTube channel, and I also believe that you're a certified financial analyst, correct?
Yeah, it's a chartered financial analyst, just a designation within the equity analysis community. Sure.
Awesome. And he has a very large YouTube presence. And I noticed recently that he posted a video about options trading, and he focuses primarily on like long-term investing, stocks, dividend investing, things of that nature. So I wanted to invite him on the channel and speak with him because I think that he has a lot of valuable insights that he can share with our community. So Joseph, would you like to introduce yourself briefly?
David, hey, thanks for having me here. Yeah, great to talk to you. Really, especially about these options investing and options trading. Over the last couple of years, especially during the pandemic, I think options trading just took off. A lot of people really interested in getting that extra leverage on their investments. And actually, it kind of went wrong for a lot of investors. A survey out from the London School of Business actually showed that options investors actually lost $5 billion over the last year and a half in options trading. So gonna really interested in looking at the mistakes that were made and how to kind of avoid that going forward. I myself come from a venture capital and equity analyst background. Spent more than 10 years as a professional analyst in venture capital and private wealth management. Started my blogs in 2014 to really kind of speak to the regular investors out there, right? As a venture capital analyst and in private wealth management, you're really only talking to that sliver of 1% of the population that can afford the services, really, those accredited investors. So really wanted to reach out to regular investors. Started the YouTube channel in 2017, grown it to over about 550,000 members in the community there on Let's Talk Money on YouTube. And just really love sharing what I've learned in investing and equity analysis with everyone.
I received a lot of emails regarding people saying that private, like high net worth individuals who have access to, they're privy to things that people who do not have a large asset base do not, aren't privy to. From your experience, are there advantages that ultra high net worth individuals receive over like the typical retail investor who maybe has like a $10,000 or $20,000 net liquidation value account size?
Well, sure. I mean, and it goes well beyond just the just having the connections with with Wall Street analysts, with the investment banks and things like that, and actually getting information that maybe they shouldn't legally be getting anyway. It goes way beyond that. It actually goes into legal ways that the high net wealth individuals are privileged over everyone else. There's actually a rule by the SEC, the Securities and Exchange Commission, called the Accredited Investor Rule, that says unless you have $1 million net worth, not including your home, or you make over $250,000 annually, unless you're in that group, the top 1% of the population, then you cannot legally invest in a lot of the alternative investments like hedge funds, private equity, a lot of those the high net worth kinds of investments that they have access to, and a lot of those, it's not necessarily that those types of investments just blow the doors off of stocks and other investments, but they are another alternative class, an asset class, and they do typically, private equity typically goes 12 to 14% annualized returns versus maybe about 9 or 10% for stocks. You've also got hedge funds that lower the risk quite a bit in a portfolio, and other types of assets. So, not only do they have those connections with investment banks to get that insider information, so to speak, then they also have access to legal access to a lot of other types of investments that regular investors just don't get access to because of those government regulations.
Yeah, that's super interesting. I feel like I definitely think that one of the major advantages is being able to gain like the tax advantage status. Like, for example, they can trade like SPX and get like the 1256 cash settlement status. So therefore it's taxed on like a long-term basis as opposed to like the short-term like incremental gains. Regarding the access to like different funds, and I definitely think that private equity access is fantastic because usually private equity funds do very well. But most hedge funds, they have a tendency to not outperform the SPYs and the QQQs. And I think that right now, because the fees of trading for retail investors have actually decreased significantly just over like the past 5 or 10 years, where just 5 years ago, I used to pay like $8.95 to place an options trade with Options House, and now I pay like 50 cents a contract, or actually like 10 cents a contract. It's even less than that. I think that I think that the spread between like an institutional investor or like a high net worth individual versus like a retail investor is probably lower than it has been. Except, I definitely agree that there are, some access like to perhaps like Renaissance Capital or like some of like the amazing funds that do exceptionally well. But
Sure.
yeah, definitely I believe that like the legal advice as far as like trusts and then things like that to minimize your tax burden is definitely something that's extremely valuable. I would like to circle back to the study that you quoted and that you spoke about in like one of your last videos, which I think is amazing, and I'll try to link to that in my video so that the viewers of this can watch it. Can you talk more about like some of the options trading mistakes and why, like with the meme stocks, why GameStop went up, like thousands of percent, but options traders who bought calls in GameStop had a tendency to lose money?
Sure, sure. Well, it's easy to see the allure of options trading, right? You significantly leverage up your capital and be able to get those higher returns. The problem is, and this was again a study by the London School of Economics or London School of Business from I believe June of 2019 through September of 2021. So it really encompassed that boom in options trading by regular investors during the pandemic. And they actually found that two components. The regular investors actually lost $1.1 billion in net aggregate on those trades. And what was really interesting was that even the trades, even the options and the stocks that did well and actually ended up making money on those options trades, they actually lost money net on the costs. And that was the second part of the losses. Options investors actually lost over $4.1 billion just in the hidden costs and the bid-ask spread and things like that in these options, which was really interesting because not only, I mean, you usually think of, you're going to make or lose money on just the investment performance itself. But I think the bigger mistake was not understanding these hidden costs and some of the spreads and the idea behind that on the investment. So, I really looked through that survey, looked through that study, and found three of the biggest mistakes leading to that $5 billion in losses. And what was even worse here was that during that period, the S&P 500, so the broader stock market, actually went up 40%. So not only did investors in these options trades actually lose money, but they lost the opportunity to just basically invest in the market index and make a lot of money, right?
Yeah.
So I think the first mistake a lot of options traders make is they're betting on those short-term expirations, right? You can buy options that expire within a week, a month, all the way up to a year or more. And I think that pull or that allure of the higher leverage and the higher potential returns really brought people into options that were expiring within the next day or even the next hour. A lot of people buying options on Friday when they expired, after the market closed. Which, of course, if you're buying an out of the money call option that still needs a significant pop in the shares, then there's a high likelihood that that's going to expire worthless and you're going to lose your entire investment, as opposed to just buying a stock where, even if the stock comes down, you still own that stock and you can still benefit from the upside. And the solution there wasn't necessarily just not to buy call options or not to participate in that leverage and that kind of thing, but just give yourself a little bit more time to participate. I actually in that video looked at one example of GameStop options, and the June $150 strike price for the call option on GameStop this year rose by 1,000%, tenfold your money back in March when where shares of GameStop had another little mini boom. But they still had 3 months left till options expiration. So you could have bought those, had 3 months left till expiration on that to really prove that upside potential. And you wouldn't be, you wouldn't lose your money completely if that stock hadn't gone up, within the next week or within the next few days. if you're going to be doing options trading or buying those call options for that upside leverage, consider a little bit longer dated options. You're still going to make a lot of money if those shares do go up, and you're going to have a little bit more time to prove that case rather than losing all your money within the next couple of days or a couple of weeks. The second big mistake there, I think, was, and this was the biggest one for cost, was really not understanding the bid-ask spread on options. The bid-ask spread, of course, the bid is just what someone is willing to pay for a stock in the market right now. The ask, what someone is willing to sell the stock for. And within just stocks, the difference in those prices is fairly marginal. Less than 1% of the stock's value usually. But when you go into options trading, that can amplify significantly. We looked at those call options on GameStop, and the bid-ask spread for the stock itself was only about 0.1% of the stock. It was about 20% spread, or 22-cent spread on like $180 stock price. When you go to the options, though, that call option had a spread of $1.70 each. And ended up being about 20% of the cost of that option if you were just to buy in at the ask price rather than maybe a little bit lower towards the bid price. And I think that's where options investors lost most of their money, right? That $4.1 billion lost in cost to options trading. Most of that was in that where options investors would just go in. Maybe they would place a market order for that call just to buy that call at any price, and then they would get that ask spread or that ask price, and be immediately down 20% on their call option. So a huge loss there. Right.
For every contract, you immediately lose $170. I mean, that's a lot to overcome, especially on a depreciating asset where usually when you buy assets, the expected move almost always works out to be less than the actual move, which is why when you buy call options, the probability of profit is usually significantly less than 50%. So yeah, you definitely have to wait for that higher expected magnitude of the move and you have to give yourself time in order for it to work out.
Yeah. So of course, and the option or the solution there is fairly simple, and not placing those market orders for options investing. Going in, placing a limit order and naming your price for the option. Naming your price somewhere in between the bid-ask spread, so you can be a little bit more assured of actually, getting that option, getting that trade exercised. But not just a market order where you're immediately going in there at the ask price at just whatever someone is willing to offer you. So definitely using a limit order to be able to manage that bid ask cost on those options trading. And third, really, the biggest mistake I see, obviously everyone loves those huge upside returns, that leverage you get from options. But I think a lot of options investors miss or ignore the other use for options, which is just for hedging and for income. It's what I use options trading mostly for, primarily. Getting those covered calls to lower your risk in a stock a little bit, maybe produce a little bit of income from stocks. A lot of those growth stocks, they're very volatile, so your options premiums are going to be very high. You can turn those into almost de facto dividend stocks, right? By selling call options against those. Still participate in some of the upside return on the stocks, but also collect some income from them.
Yeah, I agree with everything you said. In general, I prefer to sell options than to sell put options. One of the things, you used the word betting a few minutes ago when you were speaking. I think it was like during the first mistake that people make. I definitely believe that a lot of people who are like maybe in their teens or in their early 20s, they believe that making money from the stock market is extremely easy, that as long as they quote unquote put the time in, then they're almost entitled to make money, and they don't necessarily respect the fact that these are leveraged products. And while you can make money very rapidly, you can lose money significantly more rapidly, especially if you lose money and the stock goes against you, then you can be forced into a margin call, and then you can be forced to close out the position. I think that in general, from my experience, the best thing to do is to sell put options on very highly liquid, the largest market caps in the world, something like Apple, Amazon, JP Morgan, something that has government contracts like Raytheon or RTX. And I think that is primarily the best way to consistently make money in the market. And then if the stock hits the strike price, then you can choose to get assigned the shares. And then similar to what you said, you can then sell call options on that if you want to cap your upside, but then simultaneously collect some weekly dividends, or how, if you want to sell your call option like 1 or 2 weeks out or a month out, you can collect more premium, obviously. But I think that one of the biggest problems is that when we see situations like what transpired in 2021, where the market was up like 30 to 40%, and then you had meme stocks appreciating thousands of percent, then even if you're making 20 to 25% a year, then you're constantly tempted to take bigger swings. And as we've experienced in the first 4 months of 2022, we see that if you try to take significant risks and you try to hit home runs, then there's a significant risk and a higher propensity for you to strike out and for you to lose a lot of your money. And unfortunately, the losses are about 3 to 4 times more painful than your gains feel good when you're stair stepping your way up. So, I definitely, from my audience, we don't encourage like buying call options that are short dated in expiration. I understand that there's greater capital efficiency when you buy options, but even if, let's say right now when Amazon is trading at about like 2,200 and recently it was trading at about like 3,700, you might think that, okay, that now is a great opportunity considering that it's trading at about like 35 to close to 40% off. In that situation, if you're not using portfolio margin, which is more efficient than Regulation T, there are ways of you structuring a transaction so that it decreases your buying power reduction. For example, you can use like a synthetic long stock where you can sell an at the money put, and then you can buy an at the money call, and then you can go like 3 to 4 months out. That way, your at the money call option is being subsidized by selling the short put. So those are some things that you can do. And then, similar to what you said, if you wanted to do that, you can then sell some short dated call options against that in order to bring in some incremental money. But from looking at the study, it doesn't necessarily surprise me that that the brokerages and Wall Street in general were kind of like taking advantage, or I wouldn't necessarily say taking advantage, because the people who made those trades, they knew what they were getting into. But it doesn't surprise me that they lost money in this, because those people who bought those short dated call options were basically gambling. And usually what happens in the stock market, even though it takes a decent amount of time for it to sometimes to pan out, is that gamblers end up, losing money. And, when you compare it to the returns of like very disciplined traders who buy legitimate and strong companies with solid fundamentals.
Yeah, well, I think a lot of it was just that we've been almost spoiled over the last few years, and especially there in 2021 with the market returns, right? A lot of new investors coming into investing and just assuming, right, that stocks would always go up, even on the dips. You could buy a dip that was usually no more than 5% in the market, and be pretty well assured that the stocks were going to go higher. So. And like you said, you just have that risk-taking mentality that if you're 100% sure that the market is going to continue to go up, then why not look for that higher and higher risk? And investors found it in those options trade, in that options, especially those call options, assuming that, of course, they would make those leveraged returns. And now into 2022, we see the reality of the stock market coming back. And something entirely different.
I think, buy the dip has pretty much worked out for the past like 14 years, because even when you look at some of the largest pullbacks that we've had, so March 2020, the market was down around 36% in 33 days. But then figure like the third week of March, the market basically made like a V-shaped bottom. And then like shortly thereafter, it hit like a new trading high. And then you had like, December of 2018, and then like February of 2018, where volatility increased significantly in all those, and then like August 2015, in all those scenarios, the market bounced back extremely quickly, and buy the dip was the best way to proceed for investors. But, in 2022, we hit a high, I think, on January 3rd. And since then, it's basically been like 4 or 5 months of basically the market getting crushed. In your opinion, what do you think investors should be doing right now to either protect their capital or to grow their capital and to make sure that I don't want to say like wiped out. I think that that's way too strong a word, but what are some of the ways that, and I guess it depends upon your age, but what are some ways that people can protect themselves while also growing their asset base and not get hurt from the market declines?
Sure, sure. Well, that's the big question right now, isn't it? Even with the S&P 500, the broader market down something like 17, 18%, it can still go down quite a bit more. It was down 55%, 50% in the last real stock market sell-offs, right, in 2000 and 2008. So you're really looking for things that with that preservation of capital, as well as a plan. I think what's most important is that people have some kind of a plan for their capital allocation, when they're going to use the cash or those new deposits into their account to actually invest it, rather than just freaking out, looking at the market every single day, wondering if this is the bottom, if they should invest that cash, because it's really just a quick road to a coronary, right? It's making people grow old too soon, and I think so. Really placing steps on the S&P 500, so on the broader market index, say, so say you've got $100 in cash sitting in your account, you're wondering when to invest that to really get that highest return. And so, say if the market falls another, 250 points to 3750 on the S&P 500, maybe you invest 20% of that. And then you make the plan. So, okay, if it falls again to 3,500, then you're going to invest another third of your cash. And then again to maybe 3,250, then you invest the rest of it. So having that kind of a plan formalized, actually even writing it down before, really takes the stress out and takes that market timing out of it, because not only do you have some cash set aside, you're going to be able to take advantage of those lower prices if they come by, then you're not stressing out about when to do that, right? You're going to take advantage if the market does fall further, but you also get those steps of where you're able to put that money to work. So I think that's very important, just having a formalized plan to be able to know, not have to guess. It really takes the guesswork out of what you're going to do and how you're going to do it. In specific investments, I mean, I think people are really missing a great opportunity in I bonds right now, paying 9.6%. Now, of course, it's limited at $10,000 per person. You do have to hold it in there for a year. I think we're going to be under market pressure for at least a year, probably more. So I think it's a great opportunity to get something that's basically guaranteed by the U.S. government to pay 9.6% over the next year. Really, that kind of safety outside of bonds, which really aren't protecting people's money like they should be or like they have in the past. Great opportunity there. Outside of that, I think, obviously you've got some of the traditional safety sectors like utilities, consumer staples companies have done very well so far. They're down about 0.2%, about 1/5% so far this year. The stocks in those sectors within the S&P 500 now. And that's, of course, much better than the 17% drop in the S&P 500 and the 30% plus drop in stocks in the Nasdaq. So not going to guarantee that you post positive returns, but it will protect you. And a lot of those stocks in those two sectors, have those higher dividend yields. So you're at least collecting that positive cash return while you wait as well. So looking for those. Actually, I've been doing a couple of videos lately with some research, looking at stocks, specific stocks and their performance during that it was October 2007 through that March 2009 low. Really looking through the last big stock market crash, which stocks held up, which sectors and industries held up, and really some interesting ideas there. The drug makers did very well during that period. So Gilead, Abbott Labs, stocks like that. The auto parts stores actually did surprisingly well as also. So things like O'Reilly and Advanced Auto Parts, all those stocks held up very well during that last stock market crash as well. So just really looking for industries and specific stocks. Obviously the discount stores and dollar stores like Ross stores and Dollar General, those did well as well. So really looking for those niches within the stock market for some kind of safety before you get back into some of the higher beta stocks, the growth stocks and the tech stocks.
And what percentage of your portfolio do you currently have in stocks versus options?
Mm-hmm. Well, most of my options are in that a little bit more protected and income strategy. So I've got probably I'd say about 20% of my stock portfolio covered with covered calls right now. So I've got that kind of protection as well as a cash generation there. I've actually got about 20% of my portfolio in cash right now. I've got the I bonds. I've also got some cryptocurrency as well as stable coins. I've got so it'd be about 8% of the portfolio just in stable coins, and they're the larger stable coins like the USDC, which is actually backed by a reserve of dollars. So very safe there. As well as some real estate and cryptocurrency itself. So much more spread out across different assets as well. Got about 10% in bonds. I sold off most of my bonds last year ahead of obviously the inflation and the Fed raising rates, which did hurting bonds quite significantly. Though I think bonds are looking much more attractive right now. A lot of the bond indexes, a lot of the individual bonds have sold off significantly over the past 4 months. But if you look at the 10-year rate and interest rates, they've pretty well leveled off on the long end of the curve. So I think bonds are back to providing some kind of a protection as well as a yield, against the stock market weakness. So I would be looking to increase that bond percentage a little bit, maybe another 5% or so in bonds, just in case the stock market does weaken further.
And in real estate, are you invested primarily in like physical assets, or are you invested more in like ETFs and REITs like O or some of the other ones? What's your real estate holdings look like?
Sure. Well, I love the REITs. It's a very easy way to invest in real estate, those real estate stocks, but it's mostly in direct ownership. One thing that I think a lot of investors miss out on that direct ownership of real estate through rentals, through commercial space is the tax benefits on it. You get some great tax write-offs by directly owning property. And not necessarily just your primary residence, but that commercial space and those rentals that you can write off a lot of your income from that. So I think that's one thing that's important for a lot of investors.
Fantastic. So it seems like when building out your portfolio, you're using a base of stocks and then you're writing cover calls against that, or you could potentially, if you want to take ownership. If you wanted to take ownership of a stock at a lower basis, then you would sell puts and then take ownership of the stock and then like run the wheel strategy. Does that sound like what you're doing? Like you're using a basis of stock and then you're writing cover calls against that in order to generate incremental dividends?
It's a little bit more of a case by case basis, right? Like I said, I think only about 15 or maybe 20% of the stocks that I own of the money in individual stocks is really covered by those covered calls. I do have some cash secured puts on as well. I really like that strategy for getting that discount on a stock that I want to buy, especially if the premium is high enough. But yeah, a lot of times it'll be really a case by case basis. What I think about a specific stock, if the premium on the calls is high enough to really even benefit that much from selling calls on it and really covering it, as well as where I think the stock is going, the short term risks in it as well as the longer term return. A lot of those calls that I put on were on some of those growth stocks that I was investing in January, February. They had already come down so much, so the volatility was extremely high, and you were getting a really good premium selling against those. But again, the short term was too weaker on those stocks. So I wanted to protect that short term exposure to those stocks while still keeping them for the longer term growth. So I was selling calls against positions in PayPal and Teladoc and SoFi and things like that. Selling, and I'll usually sell a little bit longer dated calls just because I just don't want to mess with it every month, right? I know a lot of investors like to sell monthly calls, things like that. I'll usually go out at least 6 months or maybe even a year to the next January and sell those calls just so I can collect that higher premium and really not have to worry about it for the next year.
Are you using margin? Are you using regulation T or portfolio margin, or you're using just cash secured on everything?
Mhm. Yeah, I'm just using cash right now. I wouldn't. I mean, I wouldn't be totally against using margin, especially. I think part of that investing plan that you make can include margin. So say that you are fully invested, if the S&P 500, if the stock market falls, down to 3250, right? Which I think would be something like, 35, 40% down below its peak, which would be obviously a significant crash. If it continues to fall further, into 45% or even 50% down from the peak, I think then you could start saying, okay, you know what? So I've used through all my cash. Now I'm going to start using a little bit of margin, maybe 10 or 20% increments on my portfolio, using that margin to buy more into stocks, really take advantage of these significantly lower prices. But I don't think I would quite use margin just yet. Yes, the stock market is down. Yes, I think we do get some kind of a summer buyback or summer relief rally off of these levels. But I think over the next year it's going to be touch and go for the stock market with the Fed aggressively increasing rates, selling off or letting their balance sheet expire. So I think it's going to be tough for the stock market, and I wouldn't count out another 10 or 15 or even 20% lower on stocks, especially those growth stocks. And I wouldn't want to be in a margin position until they get down to at least 45, 50% down from their peaks.
I agree. So just two more questions. From
Sure.
one of the things that you were saying regarding like making a plan and then investing like 10 or 20% based upon the levels like the S&P or an index like the QQQs. Generally speaking, from my understanding, time in the market beats in general timing the market. So when you were saying that and you were outlining your plan, my thoughts were, okay, like that's great. But we all know that interest rates right now are very, very low. And then also like brokerage accounts tend to pay like just maybe 20 basis points on like a cash balance. So if the levels do not hit that in the index, and therefore you're just left with cash on the sideline, then you might be losing out on some opportunity costs. Now, you can also make a counter argument that if you invest right now and yesterday the S&P was down like over 150 points, then it's better than losing money. But what about like running an alternate strategy where you're selling relatively far out of the money put options and you're able to take advantage of the high implied volatility in the market right now? So let's say you sold like, options on like the SPY, or, if you were a high net worth individual, you can sell options on the SPX. Therefore, you could realize the greater tax advantage status of the SPX, the 1256 contract, and using that as a way to deploy capital and then selling it at the strike price that are like 10 or 15% below where the current market price, or rather where the market is currently trading at, as opposed to waiting and then simply buying the shares. That way you get paid on a passive basis for sacrificing your time, as opposed to simply hoping that the market is going to hit a specific level. Because over the past 14 years, the market, every single time it's pulled back, it has had a tendency to spike right back up to like a new high. Now, we can't tell the future, but what are your thoughts about selling put options that are relatively far out of the money as opposed to waiting until the market hits that level?
Sure. Yeah, I like the idea. I like the idea of basically taking those points in the S&P index and basically using those points for something like a cash secured put. Basically, it would be kind of an earmark for that portion of your money. I think you could definitely do that. I think it takes away a little bit of the flexibility that you have with just cash, and I don't know that. I don't know that just sitting in the cash would be that much of an opportunity cost. Yes, inflation is quite a bit high, fairly high, and you're not going to make any money just sitting in that cash, in those accounts as far as deposit rates. But it does give you a little bit more flexibility to if something else comes along. But yeah, I like the strategy of using those cash secured puts on the index itself to really earmark that money. It sounds like a good way to get that passive return, if the market does in fact go higher.
And my last question is, when do you buy options, or if you do buy options, in order to protect your gains? Do you either advise your clients or speak to your viewers about buying options and advise them that, hey, the good times don't always last forever. So even last year, when the market was up like 30 or 40%, and volatility was really low, which means that buying protected puts is actually incredibly inexpensive during periods of low volatility. Do you buy options in order to protect your gains or to protect your assets against the decline that we've experienced over the first 4 or 5 months of this year?
Mhm. I generally don't like to bet against the market, especially when the Fed is so accommodative like it was last year. I did have some protective puts, so basically, and usually I like to buy protective puts on the index itself, so the market itself. Obviously, nobody likes to bet against their stocks or think that their own individual stocks are going down because supposedly they're the better returns in the market. So I'll usually go into and maybe buy puts on the SPY or some other larger, broader index, especially since those puts are going to be cheaper. The premiums are going to be lower on an index itself. So did pretty well protecting some a portion of the portfolio. I usually won't do puts of more than maybe 5 or 10% when I'm buying protective puts against something like that, because I don't want to I don't want to eat into too much of my return with that premium. So yeah, a lot of times if the market is just so exuberant, so high as it was last year over the last couple of years, then I'll buy some protective puts. But I generally don't I generally don't try to bet against the market or protect against the higher market, because the market just loves to go up, and it can stay irrational and it can move higher for much longer than you can stay solvent if you're trying to spend too much money to protect against the downside.
But I think that that's great, where even if you're allocating about 5% of your overall portfolio size to like protective puts, and even if you're buying like something that's very far out of the money, like a 10 delta put on the SPY, even if the market pulls back like it has this year, those
Yeah.
10 delta puts for only 5% of your portfolio can end up protecting about 30 to 35% of your overall portfolio. So I think it's very, very difficult to time the market. And I think both of us are in agreement that allocating your capital towards the best stocks that have very high positive cash flows, that have strong brands, that have very strong prospects for the future are the best ways of moving forward. And, not betting or trying to buy like call options that expire in the short term duration on like meme stocks, they're definitely not like the best way to proceed. So yeah, I think that this was incredible. Is there anything else that you want to share, or any imparting words that you want to share with the audience?
No, just don't get panicked out of the market. I know a lot of people are seeing massive losses right now, especially if they were investing in growth stocks over the last year. But I always just point to an example of Amazon, right? Amazon crashed, went IPO in 1997. Crashed down. I think it made it up to something like $200 a share. Crashed down 95% to $5.60 a share by 2001, I believe it was. Really the bottom of the tech crash, the bubble crash. $5.60 a share. Imagine right now. Well, Amazon has come down 22 to $100 a share. It was up at around 3,500. But imagine getting Amazon, which 6 months ago was up at $3,500 a share, getting it for less than $6 a share, right? So you just have to have faith in these companies that you really believe are changing the world, are going to be those leaders over the next 10 years, and don't get panicked out of selling the shares right now.
Great advice. Can you share your YouTube channel and your website with
Sure.
viewers?
Sure. Love to see everybody in the community there on Let's Talk Money. That's the channel on YouTube, or mystockmarketbasics.com is the blog. Just kind of sharing everything I talk about on the YouTube channel, as well as just really those stock market basics that I think sometimes we all need to go back to.
Fantastic. And my name is David Jaffe with BestStockStrategy.com. You can find my channel on YouTube.com/BestStockStrategy. We really hope that you enjoyed this conversation with myself and Joseph Hogue. And if you have any additional questions, then feel free to reach out to either of us, and we'll do our best to get back to you.